The Rebel Capitalist Show.
As far as just the uncertainty that we have in the stock market, I mean, what on earth can people do? Are there sectors that you think are still cheap where people might be able to find some value and not have to chase after something that's they're trying to buy at a high price and sell it to a greater fool at even a higher price? What do you think?
I've generally found a little bit more value in some of the more cyclical companies, because not all of them though, because some of them have been hit a lot harder, whereas many of the non-cyclical companies have been bid up to extraordinarily high valuations. So part of my research is that I kind of go through individual companies and find ones that have, like, say, the strongest balance sheets in their industries, that have high returns on invested capital, that have a good track record of getting through recessions, without major equity dilution or other kind of permanent capital destruction. So I found some, opportunities in that more value-oriented sector, but by sticking to the more conservative side of that value sector, rather than, for example, people speculating on like the most leveraged oil company or the most leveraged airline, or that's the kind of speculation that I'm avoiding. But some of the stronger aspects, the stronger areas of the cyclical sectors, in addition to the precious metals and potentially the Bitcoin, for people that can stomach the volatility, I'm also using treasuries as somewhat of a counter-cyclical approach, right? So even though I don't particularly like, uh, real treasury return for potential over the next, say, call it 5 or 10 years, I do like short-term treasuries as kind of a hedge when we start to get this overbought condition in the market, right? So when we went into this crisis, I had a certain amount of treasuries in my portfolios, and then in March we took a little bit of treasuries out of the portfolio and put in a little bit of equity exposure. And then earlier this week we dialed it back, right? So we took a little bit of equity stake out, put a little more into treasuries, even though I don't particularly like treasuries as an asset class. It's kind of a volatility shock absorber, right? So that's kind of a good way to get dry powder on the side so that you can redeploy it when we get kind of an oversold condition, and to kind of just whatever volatility does at any given time, I try to be a little bit on the opposite side of that, and then look for opportunities either to kind of take some chips off the table, or to kind of make a little bit more aggressive bets on some of the companies that I've vetted pretty well.
What maturity do you usually use, Lyn?
So I have a couple different sets. So one is less than a year, and then the other one is kind of the 1 to 3 year time frame. The longer end can make for a little bit stronger hedge, but I prefer to stay out of the longer end, and I prefer to stay in the shorter end.
One thing I wanted to ask you, Lyn, before we move on to Chris, is how do you determine if something is cheap or if it's expensive?
Partially it comes down to discounted cash flows, right? So I kind of make a model for what I think they're likely to do over the next, call it 5 or 10 years, and then you go from there. And then I also look back and see what is their valuation been over the past 5, 10, 20 years, and to see how it compares. If my thesis plays out, I take a kind of a conservative version of what I think is going to happen, and I say, okay, what would the returns be if I buy it at this valuation, this kind of somewhat more bearish scenario plays out, and then I can sell it at this valuation in 5 or 10 years. What does that look like in terms of returns, and how does that compare to what I think I can get from the S&P 500? How does that compare to holding it in T-bills that whole time? How does that compare to how much precious metal exposure I want to have? So I kind of take a very fundamental view to buy companies that have. I generally focus on companies that have high returns on invested capital, fairly low valuations relative to their history, and that have preferably some type of growth in there. Even though the amount of growth I look for depends on the valuation I'm willing to accept. So if I'm looking at a higher growth company, I pay up a higher valuation, and for that kind of company I use like the PEG ratio, like so price divided by earnings divided by growth. So that's kind of the Peter Lynch famous metric. So a couple different kind of valuation approaches depending on the type of company it is.
And then how do you layer macro over that?
Mainly for asset allocation. So when it comes to how much overall equity exposure I want to have,
Okay.
if I'm expecting kind of a more deflationary crunch in asset prices like we're seeing today, or if I'm expecting like a more reflationary move. That kind of is my overall asset allocation. And then in addition, because I look at individual countries, right? So I look at their currency situations, I look at their overall like debt levels for that country, and I look at all the different kind of areas of opportunity or areas of excessive risk. So that can kind of, if I'm going to pick, say, a bank stock or a beer stock or something like that, certain countries I might kind of go into certain countries more than others depending on their macro situation.
Chris, same types of questions. How do you measure value, and how do you determine whether or not something is cheap or expensive? And then also, one thing I forgot to ask you, Lyn, but I think it's very important people understand your timing and your time frame for your investment decisions. So if you guys could expand on that as well, please.
Yeah, for me, my kind of base time frame for an individual stock is about 5 years, right?
Okay.
So it's possible that I would sell it before then. It's possible I would hold it for longer than them. But that's kind of my base assumption when I'm looking at how long I want to hold an investment for.
Okay.
Uh, Now, and then, but layering on to that, some of the macro stuff, like how much asset allocation I want, that partially depends on, overall sentiment in the market, how overbought or oversold we are at any given time. So some of my asset allocation decisions can be more, based on months,
Okay.
whereas my individual kind of company level selections are more multi-year based. But then how much exposure I want to have to like that set of companies is kind of more multi-month based.
Got it. Chris, what do you think? How do you determine if
Yeah.
something's cheap or expensive?
Well, firstly, time frame is pretty much the same as Lyn. The reality is that in most instances, a company's fortunes don't change within a 4-month time frame. That's just silly. It's really just noise, whatever you get in within a 4-month time frame. So 100% on board with what Lyn was saying there. In terms of determining, what is value, I take a similar approach. We'll look at the various metrics, but I think one of the things that, and this changed as a consequence of running venture capital business for some years, was trying to look at major cycles and how capital flows through any system. You get often capital will move into like venture capital, for example, and then it'll start moving through into the retail space if you have in large sectors, so like, and I think I've explained this before, you had like alt energy was one of the big things in sort of 04, 05, and then it kind of started flowing through into the more liquid stock markets, and you had listing of ETFs, and you had synthetic products created by the investment bankers and all this kind of fun stuff. So you kind of have these big shifts of both technology and capital, and all moving in one go. And if you can get behind those trends, basically you can be lazy to a certain extent. It's a little bit like, again, I come back to like when I started, my career in the .coms. Like if you had sort of seen some of that capital formation that was taking place well back in the early 90s, and just got behind that trend, and realized also that it was just a trend and there was a whole lot of insanity going on, you could have done really well. And so what we tend to look at doing is to find, because we're very conservative, we'll try and find, in terms of deep value, we'll just look for sectors that have been absolutely decimated, and then say, okay, why is it that they've been decimated? Are there any fundamental reasons why that would continue? Is there a change in the dynamic, and is this not being priced by the market? And then it's a matter of saying, okay, if that's a sector that you are comfortable with, and that's really, you got the macro overlay saying, okay, why is that sector the way it is? Is there some macro play involved that's caused that to take place? And then you look at that sector, and then we just want to be really conservative, because we know that timing is the most difficult of all. And so we'll try and always find companies that are just going to make it through. So we're looking for unlevered balance sheets. We're looking for strong earnings, just very strong profitability. And typically, where that leads us has in the last 3, 4, 5 years has led us towards what, like you were saying, you get a stimulus check, what are you going to spend it on? And I was saying it's like Maslow's hierarchy of needs,
Right.
And if you look at the sectors that have been decimated that are really, really cheap, many of them are in that space where on a relative basis, if you can just pull up, we'll create charts with respect to the valuation of these sectors relative to, say, the S&P, relative to the Russell, relative to the NASDAQ. And so we can kind of see where capital has flowed into and where it hasn't. And in most instances, we're buying the other side of it, and hence our time frame being longer, because it can last for longer. Does the Fed come in and just start buying all the NASDAQ stocks? It's possible. They can do whatever the hell they want. So that's kind of how we go about constructing the portfolio.